Hey, good morning. This is Mayor Valensky with Driving Markets, driving while talking about markets. Okay, so let's kick off and let's see what will be driving markets this week and what was driving markets last week. Okay, so let's finish off with last week. Last week there was a lot of volatility all around the consumer price index, which is the inflation measure. It came in as expected. And because it came in as expected, then what effectively happened is that traders, investors, investment analysts, bankers all went and bought the market. But it wasn't just one straight line up. We're talking here mainly about equity markets. We'll be talking about commodities, FX, and crypto shortly. But let's just focus on equity markets. So equity markets shot up, but the volatility was extreme. They were bouncing around, going into negative, positive, negative, positive, trying to find direction. Eventually, they found direction and they went up. And over the weekend, the futures are up again. Remember, the US is closed today due to a national holiday. All right, so what you've got is a lot of impetus and a lot of drive behind equity markets. Investors and traders have been looking for any excuse to push the markets up. And they've done that with obviously the inflation numbers coming in, which gave them a lot of encouragement that the Fed and the central banks, especially in the States, will now ease off on raising interest rates. So now looking at a 25 basis point rise in February, where previously it might have been 50 basis points. Okay, so that might be the case. And it might be the case that inflation is coming down. The numbers all indicate that inflation is coming down. In fact, the 200-day moving average of the markets of the Nasdaq, the S&P, and the Dow are all up, showing there's a bullish trend in the markets for them to go higher. And probably in the near term, to be objective, in the near term, the next week or so, you're probably going to have even further tests of limits and pushing the markets even higher as traders want to take control of the market and the bulls want to get this market up to previous high levels. That might be the case, and that might actually happen in the next few weeks. However, I'm sticking to my guns and I'm seriously stating that there is going to be not only a major recession in 2023, there's going to be a major stock market crash. And there's different opinions as to when that's going to come. Some people are talking in the second quarter, some people are talking the second half of the year. Probably going to be more likely in the second quarter, not in the first quarter. It looks like the economic indicators and the numbers that are out are going to push markets even further. This week on the equity side, you've got several companies reporting, mainly the financial sector. You've got Morgan Stanley, Goldman Sachs, you've got Charles Schwab. They're going to report the numbers out. Also, you've got Netflix reporting. So all of that will give a good corporate earnings indication as to where the companies are at and where their profitability is at, and also obviously what statements the CEOs are going to issue following on from those earnings and corporate earnings. You've also got some economic numbers out this week. You've got a big one, which is the PPI. The PPI is inflation at producer level, expecting a further drop at inflation at the producer level. The producer price index is where inflation is more or less at the producer or manufacturing level. And if inflation comes in lower than expected on the PPI, which is expected, then what's going to happen is that equity markets will go up even further and get further encouragement from the fact that inflation overall is under control. Wage inflation, retail inflation, and manufacturing inflation. If the inflation number comes in higher than expected, then obviously that is going to put with a lot of pressure and stress on equities. So in summary, you're probably going to have a rising trend line in the equity markets, the Dow, the S&P, and the Nasdaq over the next few weeks, as long as those economic numbers come in line and as long as corporate earnings come in line, then it's looking like they're going to have a rising market. What else do you have this week? You've also got retail sales for December, another big indicator. Now, if retail sales are expected to be slightly down, if they come in further down, then that actually is good news for interest rates, because that will show the Fed that the economy is cooling and therefore put less pressure on them to raise interest rates. So retail sales in the US is a big number to watch. That comes out on Wednesday. Keep an eye on that. And moving on to foreign exchange, as I said already for quite a few weeks on driving markets, the dollar uptrend has been broken, and now it looks like it's heading south. So there's the dollar is going to be weak going forward. It's going to have there's going to be strength in the pound, the euro, and the yen. Again, that strength is because there's dollar weakness, not necessarily that that currency has any particular strength. So the dollar weakness is probably going to have the euro rising. Cable, which is the pound, is going to go to around about the 125, 126, probably near term in the next 2 or 3 weeks. Dollar yen's an interesting one. The yen's picked up a bit of strength, come all the way down to 127. Again, mainly because the uptrend has been broken on the dollar. And also the Bank of Japan has an interest rate decision this week. Everyone's expecting it to stay the same. No one's expecting any interest rate rise in Japan. But since they widened the parameters of the yield on the samurai bond in Japan, then that is an indication that they're willing or looking to raise interest rates if inflation gets out of control in Japan. So keep an eye on that one for yen traders. You probably see a bit more strength in the yen, a bit more weakness in the dollar, and it's probably going to go down to around about the 123, 124 level in the near term. Oil's an interesting one. Oil rebounded 6% this week, or last week I should say, on the back of China opening, and China is a big consumer of oil. So obviously any spare capacity in the oil sector is going to be sucked in by Japan as they're looking to loosen up the economy and the restrictions. They're also going to allocate 100 billion yen, which is about $14 billion, to the rental housing markets. That's taken an absolute hammering over the last year, and they want to resuscitate that and reinflate the housing sector, or at least the rental sector. So there's going to be a lot of money pumped into the Chinese economy. They've got a trade balance coming out this week, which will be interesting to watch. Remember, China suffered from severe lockdowns over the last 3 years, and now they've eased all those lockdowns. Even though there's a spread of corona, they've thought of throwing the towel in and said, right, forget corona, let's just get the economy going, which is effectively what they're doing. Commodities, also look at gold. Gold is at 1927. Been saying all along this channel, gold is a buy, and it looks like it's going to go to $2,000 an ounce in the near term, and it could even go to $2,100. $2,000 an ounce is a big ceiling on that, and if it passes that, then the next level will be $2,100 an ounce as far as gold is concerned. So those of you who are gold traders, probably again expecting a good solid rise to $2,000 an ounce, and then from there it could be anyone's guess, because there probably will come in some buyers, but it all depends on where the dollar's at over the next week or so. So keep an eye on gold, and gold is going to pull up the other precious metals as well, considering that is the lead indicator as far as precious metals are concerned, or one of them, the most popular. The other thing to look at is cryptocurrencies. I've been saying for a while that Bitcoin is going to go down to 15 or below 15, and I've been proved wrong on that one. It's now bounced up to over $21,000 a coin, and all those crypto traders and Bitcoin traders are now questioning, is this the time to get back in? Is this the time now? Is this the time to start going long of Bitcoin and the cryptos? Well, remember, Bitcoin and cryptos are going to follow the rest of the risk asset classes. So as risk asset classes go up, which is shares, a high-tech sector, the crypto sector is going to follow on. So they're definitely going to follow on, and there's probably going to be a further rise in Bitcoin all the way through to 25,000. So you could see that overall, all high-risk sectors, whether it's the Nasdaq equities, shares, or crypto sector, is going to benefit from a lower, or an anticipation of lower interest rates going forward. So you could see a further push on in cryptos. Does that mean we've got to abandon the 15,000, it's never going to go down there? Not at all, because as the economic climate changes in 2023 and recession pulls in, then just as things go up, then things go down as well. Okay, sorry about them just holding onto the phone as I'm driving. All right, so that's more or less it. Covered most of the sections, so it's been quite a long driving markets because there's quite a lot to cover. We'll do another report tomorrow. You can catch me on Instagram and TikTok. Also do some shorts on YouTube as well as we go along. Okay, have a good day. Speak to you soon.